Every year, A16Z releases a massive report that tracks where crypto actually stands. It's filled with data on developers, users, and money flows, but most people don't have time to dig through 60 slides of charts and graphs. So, I did. What this year's report shows isn't another hype cycle or bear market collapse. It's something quieter and a lot more important. Crypto is rebuilding from the ground up. Developers are still building, real users are coming back, and the biggest financial players in the world are laying down long-term infrastructure. My name is Danylo, and today we're breaking down the key insights from A16Z's State of Crypto 2025 report in plain English. By the end, you'll have a clear picture of where the real energy in this market is moving, and what it exactly means for the next phase of crypto. If that sounds interesting to you, make sure to hit that subscribe button and ring the notification bell so you never miss future crypto updates. Alright, let's get into it. One of the clearest messages from A16Z's State of Crypto report is that the cycle has quietly restarted. Every few years, crypto moves through a familiar rhythm. Prices rise, excitement peaks, and then the noise just fades. What's left are the people who actually build. That's where we are right now, inside the builder phase that comes before the next wave of adoption. The data makes it even more clear. Despite all the market ups and downs, developer activity has held steady across most major blockchains. In some ecosystems like Solana and Ethereum, it's even starting to climb again. That's a major shift from past winters, when developers would vanish the moment token prices dropped. This time, they're staying, which means something different is happening beneath the surface. Think about what that implies for the future. When builders keep shipping, tools improve, and user experiences get smoother, it creates the conditions for the next cycle long before the prices react. It's the same pattern we've seen before. The innovation starts quietly, adoption catches up, and only then does the hype return. Right now, that quiet energy is gathering. New projects are being built, old protocols are being refined, and the entire networks are becoming faster and cheaper to use. If you're watching from the sidelines waiting for excitement to return, this is actually the moment worth paying attention to. By the time the headlines start shouting about a new bull market, the foundations of it will have already been laid by the developers working today. And that's exactly what the report captures, the subtle shift from speculation back to creation. When you look at the market today, Bitcoin still holds around half of the entire crypto market cap. At first glance, that might look like nothing's changed, but that stability actually tells a much deeper story. Bitcoin has matured. It's no longer the wild speculative bet it was a decade ago, and it's certainly not just a symbol of rebellion against the financial system anymore. It's becoming the financial system's anchor inside the digital economy. A16Z points out that Bitcoin's performance has started to resemble gold and other macro assets. In past cycles, it moved kind of wildly with all the retail hype. Now, its price moves more in sync with broader financial trends like the interest rates and institutional flows. That shift shows how it's evolving from a high-risk asset into something much more established. Institutional adoption plays a big part in that. ETFs and large custodians have made Bitcoin accessible to traditional investors, and that changes its role in the ecosystem. It's now a kind of confidence barometer for the entire market. When Bitcoin holds steady, everything else in crypto feels more secure. When it starts gaining strength, liquidity and attention naturally spread into the rest of the space. This maturity is healthy. It creates the stability that allows newer ecosystems like Solana, Ethereum, and the emerging L2 networks to grow without the constant turbulence of past cycles. It also means that volatility is no longer the main story. The story is endurance. Bitcoin has reached a point where its value comes less from the speculation and more from the trust that it has earned. So, while it might not deliver the same explosive returns it once did, it's now the foundation the rest of crypto can safely build on. Bitcoin becoming, quote, boring is exactly what makes the rest of the market more interesting. One of the most interesting findings in A16Z's report is that crypto's strongest growth isn't coming from the places you might expect. It's not the US, it's not Europe, and it's not the venture hubs that made headlines in the last cycle. The momentum is coming from emerging markets, countries like Nigeria, Argentina, Turkey, and the Philippines. In those regions, people aren't using crypto as a speculative trade, they're using it as a financial tool. When inflation is eroding, savings or the local banking system is crazy unreliable. Stablecoins and on-chain payments become a lifeline. The data shows that in many of these countries, crypto ownership and transaction volume are climbing faster than in any Western economy. And that growth is happening despite, or maybe because of, limited access to traditional finance. What's powerful about this trend is that it gives crypto a real-world purpose again. In places where financial systems are broken, decentralized money isn't a buzzword, it's actually quite practical. It helps people protect their savings, send remittances, and move value across borders without depending on the local banks. That's something the average person in a stable economy might overlook, but it's a reminder of what this technology was meant to solve in the first place. For viewers in developed countries, the takeaway is perspective. Adoption in these regions often signals what could come next globally. When real-world utility drives growth, speculation eventually follows. And as these systems become more reliable and easier to use, they won't just be a tool for survival. They'll start competing directly with legacy finance. If there's one metric in this report that captures how far crypto has come, it's stablecoin volume. According to A16Z, stablecoins settled over $9 trillion in transactions over the past year. That number is almost on par with Visa's annual settlement volume, which shows that stablecoins aren't just a niche experiment anymore. They're now a major part of global finance. What's even more telling is that nearly all of that volume, around 99.8%, is tied to the US dollar. That means the majority of global on-chain transactions are still happening in dollar-denominated assets like USDC, USDT, and PYUSD. In a way, the dollar has found a new life on the chain. It's spreading through blockchain rails faster than traditional banks or wire transfers ever could. For many people outside of the US, this has become their practical alternative to their local currencies. In countries where inflation is just really out of control, holding stablecoins is safer than keeping cash in the bank. For businesses and freelancers, it's a faster, cheaper way to get paid in dollars. And for crypto users in general, it's a bridge that connects DeFi, exchanges, and real-world commerce into one ecosystem. Stablecoins are quietly becoming the backbone of the crypto economy. They make trading smoother, DeFi protocols more liquid, and payments more stable. They also give regulators and traditional institutions something familiar to work with, dollars, while still operating within decentralized systems. That mix of trust and flexibility is exactly why companies like PayPal, Stripe, and Visa are all experimenting with stablecoin payments and settlements. It's easy to overlook, but this is the first time blockchain has reached parity with traditional payment systems in scale and reliability. While everyone was chasing NFTs or meme coins in past cycles, stablecoins were quietly building the infrastructure that makes real-world use possible. And if the growth continues at this pace, they might end up being the most successful bridge between traditional finance and the on-chain world. The report highlights another major turning point. Traditional finance isn't just experimenting with crypto anymore, it's quietly building with it. Companies like Stripe, Visa, PayPal, and even BlackRock are now integrating blockchain into real products. They're not here for the headlines or short-term speculation. They're here for efficiency and scale. Visa has been piloting stablecoin settlements directly on Ethereum and Solana, cutting transaction costs and settlement times down to seconds instead of days. Stripe recently rolled out stablecoin payouts for freelancers and creators around the world, letting them receive money faster without going through banks. And PayPal's own stablecoin, PYUSD, is live and already seeing steady adoption across DeFi platforms. These aren't experiments anymore. They're early versions of the infrastructure that will likely define global payments in the coming decade. The entry of these companies changes everything. It signals to the rest of the financial world that crypto is no longer a side project. It's becoming part of the core system. When large payment processors and asset managers move on the chain, liquidity, compliance, and user trust all follow. The rails that once powered credit cards and wire transfers are slowly being rebuilt on public blockchains. This is also where crypto's earlier groundwork starts to pay off. The developers who built DeFi protocols, Layer 2 networks, and stablecoin infrastructure during the bear market have created a base layer that institutions can now directly plug into. What's being built right now won't replace traditional finance overnight, but it's already reshaping it from the inside. It's quiet, it's steady, and it's irreversible. Institutions came for efficiency, but they'll stay for composability, the ability to connect everything they build into one open financial system. And as that system matures, the line between crypto and finance will slowly start to disappear. After the collapse of major centralized exchanges like FTX, many people assumed DeFi was dead. But A16Z's data tells a very different story. Activity across decentralized exchanges and lending protocols has quietly rebounded. On-chain volume is rising again, and total DeFi revenue is now spread across a healthier mix of platforms and blockchains than it ever did before. Solana and Hyperliquid stand out in particular. Both have been driving significant trading volume, with on-chain fees and liquidity that rival some centralized exchanges. These systems are fast, cheap, and transparent, and that combination is starting to attract traders who care less about ideology and more about performance. In many ways, DeFi has finally started competing on merit rather than hype. Another important trend is diversification. During previous cycles, DeFi was heavily concentrated around Ethereum. Now, liquidity is flowing across multiple ecosystems. You have Solana, Base, Arbitrum, and even smaller app-specific chains. That shift makes the entire space more resilient. Instead of one platform dominating everything, we're seeing a web of connected systems that can survive even when one part of the market slows down. DeFi's growth is also being driven by better design. The user interfaces are much cleaner, transaction speeds are faster, and security practices have improved since the chaos of 2021. Projects are learning from past mistakes and focusing on sustainability instead of yield chasing. This more professional version of DeFi doesn't grab headlines, but it's what makes real adoption possible. The broader takeaway is simple. Decentralized finance didn't just disappear, it evolved. It's no longer defined by speculation or over-leveraged farming loops. It's becoming the invisible layer that powers on-chain liquidity, stablecoin settlements, and even institutional integrations. The same technology that once powered meme-driven experiments is now quietly running a large part of crypto's financial plumbing. The final section of the A16Z report looks beyond 2025, where crypto starts merging with another massive shift: artificial intelligence. On the surface, they might seem like separate industries, but they're beginning to solve each other's biggest problems. AI is great at creating autonomous agents that can act, learn, and make decisions. Crypto provides the infrastructure that lets those agents own and move money. Think about that for a second. A fully autonomous AI can't open a bank account, but it can hold a crypto wallet. It can pay for data, run computations, or even hire other agents, all without human approval. That's where this overlap becomes powerful. AI needs financial autonomy, and crypto gives it a way to exist and operate independently. A16Z highlights early examples of this already happening. Developers are building on-chain agents that trade, collect data, or manage digital tasks using smart contracts. Some of them are tied to decentralized compute networks, allowing AI models to rent processing power and pay directly for it in crypto. It's a small niche now, but it is growing fast. If DeFi represents the financial layer of the internet, then this emerging AI-crypto connection could become its coordination layer. Imagine, just for a second, thousands of AI agents all transacting with each other seamlessly through wallets, stablecoins, and smart contracts. No middlemen, no friction. It's a future where value moves at machine speed. Of course, this space is still in its infancy. Most projects are experiments, and the regulatory questions are wide open. But if the past few cycles have shown anything, it's that the biggest breakthroughs usually start quietly, and the foundations being built today could define the next decade of both industries. For me, the biggest takeaway from this report is perspective. Crypto isn't dying or stagnating, it's maturing. The groundwork being built right now will power the next generation of digital finance. So, if you've stuck around through all of this volatility, this might be the most important phase to pay attention to. But I'm curious for you. After seeing what's happening behind the scenes, do you think we're heading into a new bull market or just a smarter version of crypto altogether? If you found this breakdown helpful, make sure to hit that subscribe button and ring the notification bell so you don't miss future crypto updates. I'll keep covering where the real momentum is happening on the chain and help you stay ahead of what's next. Thanks for watching, and I'll see you in the next one.